Imagine a company holding over 500,000 bitcoins, worth more than $40 billion, and refusing to show the world where those coins are stored. Now imagine that company is led by one of the most vocal Bitcoin evangelists, with a reputation for relentless public advocacy. The company is Strategy, the man is Michael Saylor, and the question that's sending shockwaves across crypto and Wall Street alike is, why won't they prove their reserves once and for all? In an era where trust is everything and transparency is king, Strategy's refusal to publicly reveal its Bitcoin addresses has ignited a firestorm. Is this a smart move to protect digital assets from hackers and opportunists, or a red flag hiding something far darker, perhaps proof that Strategy's holdings aren't all they claim to be? As institutional money floods into crypto, the answer doesn't just affect one company. It could shape the future of digital asset custody, investor trust, and even how the next financial crisis unfolds. Tonight, we unpack the full story behind Bitcoin's most contentious secret, and what's at stake for everyone who cares where the money really is. First, let's rewind. How did we get here? Why does the idea of proof of reserves even exist? And why is it suddenly front-page news? Proof of reserves is, at heart, a very simple concept. Show us the assets you claim to hold. In traditional banking, regulators require banks to keep a minimum percentage of deposits on hand, ensuring that customer withdrawals can be honored. But in crypto, with its roots in radical transparency and decentralized trust, the expectation is higher. Exchanges and custodians are pressured not just to be solvent, but to demonstrate it, publicly, on-chain. The push for proof of reserves didn't come out of nowhere. It was a direct response to some of the most catastrophic failures in crypto history. In 2014, the Mt. Gox exchange collapsed, losing 850,000 bitcoins, worth billions at today's prices, due to a mix of theft, mismanagement, and what some would later call outright fraud. For years, customers had no clue their coins were gone. Fast forward to late 2022. FTX, led by Sam Bankman-Fried, was considered a paragon of transparency, right up until it imploded in spectacular fashion, leaving a $9 billion hole in customer funds. The world demanded answers. Proof of reserves became a rallying cry. But proving reserves in crypto isn't so simple. In its earliest days, exchanges would post wallet addresses and balances, a move that, in theory, would allow anyone to check, verify, and trust. Yet cracks quickly appeared in this model. Publishing addresses can expose the company and its users to considerable risk. Hackers, scammers, even nation-state actors started tracking and targeting large wallets. Public disclosure became a double-edged sword. As the crypto market grew, and institutional investors got more involved, more sophisticated methods appeared. Merkle tree proofs allowed exchanges to prove each customer's balance was included in total holdings, without exposing everyone's data. Some pushed for zero-knowledge cryptography, mathematical magic that proves you have something without revealing what, or where, it is. Institutions like MIT publicly demonstrated how homomorphic encryption could, in theory, verify solvency without ever exposing underlying wallet data. And let's not forget the traditional world. Big-name audit firms like KPMG and Deloitte began offering full-scale crypto audits, borrowing the old playbook from corporate finance. But even as these methods evolved, one thing stayed the same. In a market built on distrust of centralized power, anything short of total transparency came under fire. That's why, when Strategy, the world's largest corporate Bitcoin holder, refused to reveal its addresses, the reaction was nothing short of explosive. Let's get specific. As of late May 2025, Strategy claims to hold over 580,000 Bitcoins. The company is open about its buying sprees, the press releases, the quarterly filings, the headline-grabbing statements from Michael Saylor. But on the question of addresses, the cryptographic proof, the answer is always no. Skeptics, including other crypto billionaires and high-profile CEOs, have publicly accused Saylor of dodging. Changpeng Zhao, known as CZ and the founder of Binance, even joked that Saylor probably sold bitcoins. Social media lit up with speculation and memes, fanning the flames of doubt. If Bitcoin wallets are unhackable, as most cryptographers assert, why not prove it? Why so secretive? Arkham Intelligence, a blockchain analytics firm, tried to settle the matter in January 2025, claiming it had identified 96% of Strategy's Bitcoin addresses. Yet even they couldn't account for the remaining 4%, a portion that, given today's BTC price, amounts to billions of dollars left unaccounted for. And crucially, Strategy neither confirmed nor denied Arkham's findings, leaving the door wide open for speculation. Michael Saylor finally addressed the controversy directly. In an 8-minute speech on X, the platform formerly known as Twitter, he argued that publishing the addresses would be reckless, a direct threat to the company's security, its custodian partners, and its corporate investors. "It's like publishing the bank accounts and phone numbers of all your kids," Saylor said, "and then thinking that makes your family better." His analogy struck a nerve but didn't satisfy critics. Saylor's core message: for a public company like Strategy, disclosure should come through regulated audits, not through on-chain transparency. He invoked the specter of past disasters, Mt. Gox, FTX, as warnings not against secrecy, but against reckless trust in offshore platforms and amateur custodians. Better, he said, to trust the Big Four audit process, the checks and balances of American financial law, and the threat of jail time for misreporting under the Sarbanes-Oxley Act. But is that enough? In the words of security expert Bruce Schneier, security is not a static product but an ongoing process. Proof of reserves offers a snapshot in time, but continuous monitoring is paramount. Saylor's stance, echoing the traditional playbook of audits and legal compliance, runs counter to the transparency ethos that made Bitcoin famous. And as risk management expert Preston Byrne notes, the challenge isn't just to prove reserves, but to substantiate liabilities. In other words, it's not enough to show what you have, you need to show what you owe. Meanwhile, the landscape is hardly settled. Some companies, like Bitwise, do publish their addresses, and somehow manage to keep both transparency and security intact. But Bitwise is a rare exception. Most major Bitcoin holding corporations stay silent, watching the fallout from afar. Why risk becoming a target for hackers or regulators? Regulators aren't standing still. The Financial Accounting Standards Board, FASB, in the U.S. now requires public companies to disclose comprehensive details of their crypto holdings, though not the wallet addresses themselves. The European Banking Authority is working on new rules specifically targeting proof of reserves and customer fund segregation. The Bank for International Settlements is researching next-generation cryptographic solutions for reserve verification. Even MIT is getting involved, demonstrating that it's possible, at least in theory, to achieve both privacy and auditability. A recent survey of institutional investors tells another part of the story. 60% now prefer proof of reserve solutions that integrate with familiar regulatory processes. That's a huge market signal. Investors may care less about on-chain transparency and more about legal, auditable provenance. But the crypto community, especially its most passionate advocates, remains fiercely divided. Lynn Alden, a prominent Bitcoin analyst, doesn't mince words. Bitcoin's core value proposition is not transparency, but verifiable scarcity. Proof of reserves serves as a distraction from the genuine risks involved. But Ria Butoria, head of research at Circle, draws a different line. Transparency is indispensable for fostering trust within the digital asset ecosystem. It's an emotional debate, one blending fear, hope, and the memory of past rug pulls. On one side, the transparency absolutists, who argue that anything less than public addresses is an invitation for fraud. On the other, the pragmatists, who warn that such disclosures turn companies into sitting ducks for hackers and social engineers. The technical arms race is relentless. Some exchanges are implementing bug bounty programs to crowdsource security, rewarding white-hat hackers for finding flaws before the criminals do. Decentralized exchanges are experimenting with community audits, crowdsourced solvency checks where token holders are incentivized to verify claims. The most advanced exchanges are actively piloting zero-knowledge proofs and secure multi-party computation, aiming to compute complex proofs without ever exposing private data. Yet for every new solution, new questions arise. Can crypto custodians ever achieve the same level of trust as traditional banks without sacrificing the very transparency that makes crypto unique? Is regulatory compliance a shield or a smokescreen? And most of all, if Strategy, a leader in corporate crypto adoption, can't or won't prove its reserves on-chain, what does that mean for the companies and investors following in its wake? Some argue that the difference is scale. Bitwise, for example, manages to publish its addresses, but only holds a fraction of Strategy's hoard. At Strategy's size, even a tiny mistake could be catastrophic. One leak could put billions at risk. Others say that's an excuse, not a justification. If anything, larger reserves demand greater scrutiny. The stakes are rising, not just for Strategy, but for the entire crypto ecosystem. A Chainalysis report shows that exchanges employing transparent proof of reserves have seen a 15% jump in institutional inflows, a sign that transparency isn't just a principle, but a competitive advantage. With legislators, auditors, hackers, and everyday users all pulling in different directions, the spotlight is fixed on Michael Saylor and Strategy. Will they embrace confidential POR technologies like zero-knowledge proofs or stick with old-school audits? Will regulators force their hand, or will the market punish them for secrecy? As the pressure mounts, the world is left waiting for an answer. Will the corporate whale finally open the vault? Or will the question of trust in crypto's biggest players remain the unsolved mystery at the heart of the digital gold rush? In the second half of this video, we'll dig deeper. What are the real consequences, good and bad, if Strategy and others never publish their proof of reserves? Is a technological breakthrough on the horizon, or is this transparency standoff here to stay? And most importantly, what should investors, big and small, believe and do as the debate rages on? So where does all this leave Strategy, the wider industry, and most importantly, the future of trust in corporate Bitcoin holdings? As we look ahead, the crossroads of transparency and security only become more complex, paved with both risks and remarkable opportunities. Right now, despite the endless Twitter debates and expert panels, no one, neither the Bitcoin maximalists nor the corporate giants, has found a silver bullet. But change is coming, whether anyone likes it or not. Let's dig into what could happen next, how this tension might reshape not just how companies like Strategy operate, but the very fabric of the crypto economy. Picture this. Regulatory watchdogs, emboldened by past disasters like FTX and Mt. Gox, step in with new marching orders. Governments around the world, wary of crypto's wild reputation, may soon demand rigorous proof of reserves, and not just in the form of wallet screenshots. The European Banking Authority, for example, is already drafting detailed guidelines for crypto service providers. Imagine a reality where every big holder, be it Strategy or one of its competitors, must prove, beyond a shadow of a doubt and on a regular basis, that the assets they claim are on their books actually exist. But here's the twist. Regulators themselves face a conundrum. Too much transparency might invite attacks, both digital and physical. Too little, and confidence evaporates. The pressure is on for new cryptographic tools, zero-knowledge proofs, multi-party computations, and homomorphic encryption to deliver ironclad audits without revealing sensitive details. Some visionaries predict that within just a couple of years, hybrid models will become the norm. Companies will combine the strengths of on-chain proof, traditional audits, and privacy-preserving tech like ZK snarks. With these, they can demonstrate solvency and honesty, but keep critical operational details shielded from prying eyes. There's another possibility, one that could utterly reshape the landscape. If the industry fails to reach a robust and trusted standard, the ultimate losers may not be the companies, but individual investors. Skepticism may spread, driving capital away from centralized holdings towards true self-custody and decentralized protocols. Already we're watching a silent migration as some institutions and retail holders abandon exchanges and custodians, preferring cold storage and DeFi platforms they can verify themselves. In a world where trust is increasingly fragile, the mantra of "not your keys, not your coins" rings louder than ever. But optimism is not dead. In fact, the seeds of a trust renaissance are quietly sprouting. Academic teams at MIT and firms like Chainalysis are hard at work on technologies that could one day let any user instantly verify a company's reserves without seeing addresses or balances. Recent pilot programs have shown promise, with exchanges using advanced encryption to offer real-time, third-party verifiable solvency checks. The next breakthrough may be just around the corner, and it could tip the balance permanently in favor of both transparency and safety. Influential voices within the industry, like Ria Butoria from Circle, insist transparency is indispensable for fostering trust within the digital asset ecosystem. Her words echo among institutional investors who, according to a recent survey, overwhelmingly favor proof-of-reserve solutions that sync with existing regulatory frameworks. The message is clear. For big players to survive and thrive, they need to set a new standard, one that ordinary people can trust, and that sophisticated adversaries can't exploit. But how could such a future impact everyday viewers, those who might not own a corporate treasury of Bitcoin, but care deeply about the safety of their investments, savings, or retirement funds? First, this debate is not just for billionaires or CEOs. It directly affects anyone with skin in the crypto game. from the college student with her first Satoshis to the hedge fund manager overseeing millions. Understanding the current limits of proof of reserves means you can make smarter decisions about where to park your assets and whom to trust with your money. Consider this. If your favorite exchange or service touts proof of reserves, dig deeper. Are they using transparent on-chain methods? Do they employ sophisticated cryptography like Merkle trees or, even better, zero-knowledge proofs? Do they have regular audits by reputable firms? Or is the proof little more than smoke and mirrors, an illusion meant to placate rather than protect? Second, remember that true security always depends on more than technology. As security expert Bruce Schneier famously says, security is not a static product but an ongoing process. Even the best proof of reserve snapshot can't protect against mismanagement, fraud, or unforeseen black swan events. Don't let a flashy seal of approval lull you into complacency. Diversify, stay curious, and stay informed. If you're a builder, a developer, entrepreneur, or founder, now is the time to pay close attention to this unfolding story. The next few years will see a wave of innovation in privacy-preserving auditing, compliance tech, and user-verifiable proofs. The companies and products that master this balancing act will set the tone for the entire industry. That means building open, transparent, and secure systems, not just because regulators demand it, but because the market will reward those who earn trust the hard way. And what about the rest of us? Even if you're not directly responsible for billions in digital assets, the principle still matters. Every payment you make, every token you buy, every app you use depends, at some level, on trust. Whether you're investing in crypto or simply watching the space evolve, understanding these debates will give you a sharper edge. You'll be able to spot hype, sniff out red flags, and demand better from those who claim to safeguard your wealth. Now let's return to the burning question from our opening. Will Strategy and the crypto industry at large find a solution that actually satisfies both security and trust? Or are we doomed to a never-ending standoff, with each side pointing fingers and refusing to budge? Based on the evidence, there is no one-size-fits-all answer. The truth is, a perfect balance may forever elude us. Strategy's refusal to disclose its wallet addresses is not simple stubbornness or secrecy. It's a calculated trade-off, rooted in the harsh lessons of past catastrophes and the limitations of current technology. Michael Saylor's stance, that traditional audits, multiple layers of verification, and trusted professional oversight are good enough, reflects the reality of institutional finance today. Yet, as blockchain-native companies like Bitwise demonstrate, it is possible to achieve radical transparency without inviting disaster, at least so far. The path forward will likely be messy, uneven, and fiercely debated. Some companies will double down on privacy, citing risks to employees and clients. Others, under pressure from regulators and markets, will experiment with ever more advanced cryptography and community audits. In the end, the winners will be those who can prove, to both the tech-savvy and the skeptical, that they hold what they claim, while keeping their defenses impenetrable. There's a powerful lesson here. Trust is not a static achievement, but a living contract, constantly renegotiated, sometimes broken, but always vital. No system is invulnerable, no proof is perfect, but by demanding higher standards, supporting innovation, and refusing to be blinded by hype, we all become stewards of a more resilient financial future. And here's a secret fact you won't hear on most mainstream channels. Several exchanges experimenting with transparent proof of reserves have seen a surge, over 15%, in institutional inflows. This isn't just about ideology or philosophy. The market is already voting with its feet, choosing transparency when given the option. So, as you watch this saga continue to unfold, debates at conferences, regulatory crackdowns, and the next wave of technological breakthroughs, don't just be a bystander. Ask questions, demand evidence, and make trust a requirement, not an afterthought. If you liked this deep dive and want to stay ahead of the blockchain curve, hit that subscribe button and join the conversation in the comments below. What do you think? Should Strategy reveal its addresses? Or is ironclad privacy the price we pay for true security? Let us know where you